Welcome back to the deep dive. Today we are strapping in for a high-speed tour through the engine room of global finance.
We are. We're looking at the full Q4 and full year 2025 results for JPMorgan Chase.
And just so you know, we are working strictly from their official materials, the press release and the big slide deck, both dated January 13th, 2026.
Our mission here is, I think, pretty vital. When you see the headlines for a bank this size, the numbers can be just overwhelming or, worse, completely misleading.
Right.
So we're going to help you filter that noise. We need to separate the core health of their lending from, say, volatile market activity and really dig into the one big thing that overshadowed everything else this quarter.
That one event really is the key to this whole deep dive, isn't it? Because if you just look at the top line numbers for Q4, they report on a managed basis. You see managed revenue at $46.8 billion. That's up a solid 7% year over year. That's great growth.
It is. But then you get to the punchline. The reported net income actually dropped 7%. It went down to $13 billion.
So revenue is up, but profit is down. I mean, that's a huge alarm bell for any investor, unless you know what's really going on underneath.
Exactly. What's the context?
Let's solve that mystery right now. That $13 billion figure, it's just not the real story. What happened?
Okay, so the bank took this massive, specific one-time charge, a $2.2 billion credit reserve.
And this wasn't because customers were defaulting everywhere.
No, not at all. This was a strategic provision. It's related to their forward purchase commitment of the huge Apple credit card portfolio.
So this is a classic accounting move. You make a big strategic decision for the long term, but it gives you this short-term kind of ugly hit on the balance sheet.
That's it exactly. They're setting themselves up for a huge future gain by getting this portfolio, but they have to put the capital aside today to cover any potential future losses.
So if we use their preferred metric, the non-GAAP number, which pulls this item out, how does the picture change?
It changes completely. You exclude that $2.2 billion charge, and the Q4 net income was actually $14.7 billion.
Wow. So that flips a 7% loss into a massive win. And that must do wonders for their efficiency metric, the return on tangible common equity, the ROTCE.
Absolutely. The reported ROTCE was 18%, but the adjusted core ROTCE, that was 20%.
And that 20% number, that's the real indicator of how the core business is doing.
That's the one. It shows the underlying health of the business was actually excellent during the quarter.
So the headline story is one of great operational health, just temporarily masked by a very aggressive strategic acquisition.
And looking at the full year, they were incredibly strong. $57 billion in net income on, $185 billion in revenue? And that 20% ROTCE held up for the whole year.
It really speaks to what Jamie Dimon said about the patient and thoughtful deployment of excess capital.
It does. They're strong enough to make a multi-billion-dollar play like this.
Yeah.
But it does hit their regulatory capital right away, which, just shows how big of a commitment this is.
So how big was that hit to capital? We don't need to get lost in the weeds, but what's the main takeaway?
The takeaway is it was a big bite up front. This one commitment, just for the Apple Card, it dropped their standardized capital ratio by about 25 basis points.
Which is noticeable.
It's noticeable, but their starting point was so strong, they ended the quarter with a CET1 ratio of 14.5%. So they absorbed it pretty comfortably.
Okay, let's peel back the layers now and look at where the income actually came from. How did core lending do versus, say, fees and trading in Q4?
Well, both sides of the house were healthy, both up 7% year over year. Net interest income, NII, the money from lending was $25.1 billion.
And the other side?
Non-interest revenue, or NIR, so that's your fees, trading, asset management, that was $21.7 billion.
We often talk about NII excluding markets as the truest measure of the core lending franchise, right? Because trading can be so volatile.
Right. And that core lending NII was $23.9 billion. That's a 4% rise.
Now, 4%, it might not sound explosive, but given the macro environment, that feels pretty strong.
It is strong.
Why, though? You'd think with rates maybe stabilizing or even softening a bit, that tailwind would be gone. What drove the growth?
It was pure volume and scale. They saw higher deposit balances, so they have more money to lend out. But the key driver was consumer activity, specifically higher revolving balances in card services.
So even if rates weren't helping as much, people were just borrowing more on their credit cards.
Exactly. That sheer volume pushed the NII higher.
That's a really important window into the consumer mindset. Resilient, but maybe leaning more on credit.
I think that's right. Meanwhile, that non-interest revenue was also up 7%, driven by steady growth in asset management fees and really strong payments income. It's a beautifully diversified stream.
Speaking of things that require cash, let's talk expenses. $24 billion for Q4, up 5%. Where's that money going? Inflation or investment?
It's overwhelmingly strategic investment. Yes, there's always some inflation, but the main drivers were tied to growth.
Like what?
Higher compensation. And this wasn't just bigger bonuses. It was hiring more front office employees, more bankers, more advisors. They're investing in people.
Okay.
And then you also saw higher costs for things like auto lease depreciation and brokerage fees.
All right, what about credit costs? Outside of that big Apple Card reserve, were existing loans under pressure? Because credit costs hit $4.7 billion in the quarter. That's a big jump.
It is a big jump. And that's where we see the rubber meeting the road on consumer health. That number included $2.5 billion in net charge-offs. That's money they just don't expect to get back.
And for the full year?
For the full year, NCOs hit $9.8 billion, up $1.2 billion from the year before.
Almost $10 million in charge-offs. That's a huge number. Where's the pressure coming from?
It's predominantly in wholesale, so corporate clients, but also pretty significantly in card services. It confirms what we saw in the NII numbers.
Yeah.
Consumers are using credit, and some of that credit is, deteriorating.
It's not a crisis, but it's normalizing back to historical levels.
Exactly. It's something management is watching very closely.
Okay, let's break it down by segment. This is where you really see the diversification story come alive. And we have to start with the powerhouse, the CIB, the Commercial Investment Bank.
The CIB was, without a doubt, the star of the show in Q4. Net income hit a remarkable $7.3 billion. That's up 10%. And the strength was all in the markets business.
The trading floor was on fire. Markets revenue up 17% overall to $8.2 billion. But the number that really just makes you stop is equity markets revenue. It jumped a massive 40% year over year.
40% in 3 months. It's just stunning for a business this large.
Yeah.
And that was mainly driven by their prime brokerage business.
Wait, let's pause there. For anyone listening who isn't on a trading floor, what exactly is prime brokerage and why does it drive a 40% jump?
So prime brokerage is basically the high-touch services desk for the biggest clients. Think hedge funds, big institutions. It's where they borrow money to buy stocks, borrow stocks to short them. It's all the complex plumbing behind their trades.
I see.
So when equity markets are really active, volatile, and seeing big inflows, these huge investors use prime services like crazy. And the fees from that just explode. That 40% jump tells you there was frenetic, high-dollar activity among the biggest players in Q4.
So booming markets means booming CIB income. And fixed income also had a good quarter, up 7%.
It did. But it's interesting, while trading was hot, the traditional investment banking fees were kind of lukewarm, down 5%.
That's a really important contrast, isn't it? Trading is real-time, but IB fees for M&A and IPOs, that's about long-term confidence.
Exactly. The fact that IB fees were down suggests that, corporate C-suites are still a bit cautious about pulling the trigger on huge deals, even with strong markets.
Let's move to another area of strength, asset and wealth management, AWM. Talk about scale.
AWM had a very strong quarter. Net income was up 19% to $1.8 billion. But the story here is just simple. Assets. AUM, assets under management, hit a record $4.8 trillion.
And total client assets.
Total client assets reached $7.1 trillion, up 20% in a year.
7.1 trillion. I mean, just to put that in perspective for you listening, that's roughly the annual GDP of Japan and Germany put together. It's an almost unimaginable amount of wealth.
And it wasn't just the market going up. Yes, that helped, but this was crucially driven by strong net inflows. For the full year, they brought in $553 billion in new client money.
That figure is just a massive vote of confidence. When you see over $500 billion in new money walking in the door, it means people are actively choosing JPM for stability.
It's the ultimate metric of trust and brand power in wealth management.
Okay, finally, let's hit the consumer and community banking side, CCB. This is the segment that took the hit from that Apple Card reserve.
It did. CCB net income was down 19% to $3.6 billion, and that's a direct reflection of that big charge. But if you look underneath, operationally, the franchise health is maybe the best part of the story.
What did you see?
Jamie Dimon pointed out they opened 1.7 million net new checking accounts and get this, 10.4 million new credit card accounts for the year.
10 million new credit cards in 1 year. That is an absolute machine for customer acquisition.
It is. And they're engaging them digitally. Active mobile customers hit nearly 62 million, up 7%.
So the customer base is very healthy. What about the credit metrics on the consumer side specifically?
Well, the card services net charge-off rate for Q4 was 3.14%.
Is that good or bad?
It's actually slightly better than the 3.3% they saw in the same quarter last year. So while overall credit costs are rising, the most watched part of the consumer book actually showed a little bit of moderation. It's a stabilizing factor.
Let's turn the page to 2026. This is maybe the most important part of the whole release. What's their guidance for net interest income for the coming year?
They're forecasting their core NII, so excluding markets again, to be around $95 billion for the full year. That's a slight bump from the $92.6 billion they just posted.
NII growth, even if the Fed starts cutting rates, that's got to be based on a specific economic assumption, right?
It is. Their forecast is explicitly based on the rate curve from early January, which bakes in the expectation of 2 Fed rate cuts during the year.
2 cuts. So they're planning for lower rates, but still expecting NII to grow, probably from more card borrowing and more deposits. It's a pretty optimistic view.
It is optimistic, but the price of that future growth is massive. This brings us to their expense forecast, which I think is the biggest shocker in the whole outlook.
Oh, yeah.
They expect their adjusted expense for 2026 to be approximately $105 billion.
Wait, that's a nearly $10 billion increase in annual expenses. That's not just a spending plan, that's an aggressive declaration of war on their competition.
It absolutely is.
What's driving a $10 billion investment?
It's about future-proofing the whole company on 3 fronts. First, and most importantly, technology. They are pouring billions into tech, software, and especially data and analytics.
Betting that tech superiority is the only way to win long-term.
100%. The second front is physical and human. They're investing in more bankers, more advisors, and more branches.
So they still believe in the human touch.
They do. And the third driver is marketing. They're planning to spend more, especially to drive demand for those credit card products. It's a full-spectrum investment: digital, physical, and consumer mindshare.
It's a risky but powerful strategy, willing to squeeze margins today for overwhelming growth tomorrow.
Right. And they're still cautious. Even with all this, they expect the card services charge-off rate to climb a bit to around 3.4% for 2026.
So even with all the positive signs, they're still building in a modest increase in consumer credit losses, a very sober acknowledgement of the risks.
It's prudence mixed with aggression.
Let's pull back for the big picture. Jamie Dimon's overall take on the economy. What was his sentiment?
He was emphatic about the resilience of the U.S. economy. He noted consumers are still spending, businesses are healthy. He said these conditions could persist for some time. So he's optimistic about the foundation.
But he never gives optimism without a huge dose of caution. What did he say markets are ignoring?
He warned that, and I'm quoting, markets seem to underappreciate the potential hazards. He listed complex geopolitics, the risk of sticky inflation, and elevated asset prices. A little warning that the stock market might be ahead of itself.
That's the luxury of running a bank with a fortress balance sheet. They can afford to be cautious and invest heavily at the same time.
Exactly. They're basically saying, we're strong, we're investing, but don't ignore the storm clouds brewing out there.
Okay, to summarize this whole deep dive, JPM had a very strong 2025. Core profitability was great, especially in the CIB and AWM. The only thing that made Q4 look soft was that huge but strategic upfront cost for the Apple Card portfolio.
And the 2026 outlook just doubles down on that aggression. Planning for NII growth even with rate cuts and fueling it with a staggering $10 billion in new annual spending on tech and talent.
Which leaves us with a provocative thought for you to think about. JPM is thriving on 2 pillars right now. The volatile, high-performing markets business that saw a 40% jump in equity revenue, and that massive high-cost investment strategy in their expense budget. If Dimon's warnings about geopolitics or sticky inflation actually happen, which of those 2 pillars, the volatile income stream or the high fixed expense base, will be the first to crack, and which will ultimately define the strength or the weakness of JPMorgan Chase in the back half of 2026?